bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the July 9th, 2024 podcast. Before we start, I do want to thank my partners, Brad Elphick and Dirk Wallace, for sitting in for me the past few weeks. That said, now that I'm back from a brief, rejuvenating July 4th vacation, I'm very excited to be bringing you this week's podcast, especially since the topic is so critical to the long-term preservation of low-income housing tax credit subsidized affordable rural housing. Today's topic is commonly referred to as Year 15 or Y15. Year 15 or Y15 is shorthand for the end of the initial compliance period for low-income housing tax credit property. Technically, the end of Year 15 represents the end of the tax credit recapture period for investors. Most investors plan to exit tax credit partnerships shortly after the end of the recapture period. And most developers they want to see their investors leave the partnership at this. Now, those of you who are watching on YouTube, you can see that with me here today is my partner, Nicolo Pinoli. Nicolo is the perfect guest for this topic for a variety of reasons, but no more than he is the lead author of the Novogradac Year 15 Handbook, which is being released today, the same date as podcast post. Novogradac's Year 15 Handbook covers a broad array of issues and information about Year 15. The book, as this won't be a surprise, goes far beyond what we're going to discuss today. So I do encourage anyone involved in LIHTC housing to order a copy of the handbook. Now, today's podcast is a follow-up to two prior podcasts. Back in 2021, Nicolo was a guest, and he explained why it's rare for investors and developers to take no action shortly after the end of Year 15. And in that podcast, Nicolo and I went on to discuss steps developers should take as Year 15 approaches. We then reviewed several more standard or common Year 15 exit or separation strategies, as well as a few less common ones. That 2021 podcast would follow up a year later in 2022, where my partner, Kevin Wilson, who, so coincidentally, will be my guest next week, joined me to go a bit more in depth into how to prepare for and assess various Year 15 options. Kevin explained that the first step to take, as with most things in life, is to gather the necessary information. The second step, Kevin explained, was to review the rights and desires of the partners at the end of Year 15. And the third step is for the partners to negotiate how they want the partnership to proceed. I will provide links to both of those podcasts in today's show notes. Now, in today's podcast, to build upon those two prior podcasts, Nico and I will go more in depth into three approaches or strategies that are commonly seen at Year 15. The first approach deals with the right of first refusal. Here, Nicolo and I will explain what a ROFR, right of first refusal, is and some commonly faced interpretive issues. Second, we'll explain and review the qualified contact process. Then finally, we'll address resyndication and some structuring and ownership limitations imposed under current law. We have an exciting podcast, in-depth podcast for you today. If you're ready, let's get started. Nicolo, welcome back to Tax Credit Tuesday. You've been a guest many times, most recently back in March of this year when we discussed the, I guess it's not so recent, tax credit really now, concerning bond issuance costs. But for our newer listeners, please provide a brief self-introduction and discuss some of the ways you serve Novogradac clients.
Well, thanks for having me, Mike. My name is Nicolo, and I am a partner in our Portland, Oregon office. And I work in our audit and tax department. And certainly I do a lot of work in the low-income housing tax credit industry ever since I started at the firm back in 2002. In addition to doing all the usual sorts of traditional audit and tax services, I also do a lot of work with my clients on Year 15 issues, initial underwriting, helping them apply for tax credits, and work through all the sorts of fun things that you experience during the entire life cycle of a deal. So soup to nuts, pretty extensive experience and history working with clients on all their issues with their low-income housing tax credit properties.
Right. Thank you for that, Nicolo. And now let's dive into our topics for today. And as I noted in the introduction, today's a bit more advanced than some of our other podcasts. Our goal as we discuss these issues is to share some of the interpretation that we've seen asserted, some of the possible conflicts that can arise around these items. Now, as I said in the intro, year 15 is a time when there's often a desire by the investor limited partner, should say generally or nearly universally, a desire by the investor limited partner and the developer general partner to part ways. And we're going to start with the right of first refusal, or ROFR. Now, under a ROFR, to maybe level set for our listeners, a housing nonprofit has a right to purchase the property at a price typically equal to debt plus taxes if the partnership makes a decision to sell the property and the partnership then receives an offer to buy the property. Now, not all lawfully attached partnerships have a ROFR held by a qualified nonprofit, but many do. Now, as you know, Nicolo, what I just said in terms of describing ROFR as typically being at a price equal to debt plus taxes and being triggered if the partnership makes a decision to sell the property and the partnership then receives an offer to buy the property, that sounds simple, sounds straightforward, but it's not. So I would like for you to share with viewers, with our audience, some of the issues that arise when a nonprofit holds a ROFR.
I think the first place I always start with is, how is the ROFR triggered? And you mentioned some of the issues that can arise when it comes to triggering a ROFR. And I think part of the fun with ROFRs is they're often poorly understood. For many groups, they view them as more akin to an option where they can unilaterally trigger them. And of course, the trouble is that, at least as provided for under federal tax law, they are intended to very much be a right of first refusal as opposed to an option. You mentioned, Mike, the issue around partnership needing to make a decision around, let's go ahead and sell the property. So the big issue then is, well, who makes that decision on behalf of the partnership? And are there any approval rights that any of the partners might have come along with it? And usually the big issue is, to what extent can the general partner make that decision on their own, or does the general partner need to have concurrence from the limited partner? And the only answer I can give you, and anyone can give you, is it depends on what your documents say. And ultimately, your documents will always control, because this is a contractual right. While there's certainly a provision that it can exist under federal tax law, that doesn't mean it's a constitutional right that one has to exist and what it has to say. And certainly as a result, the details outlined in contractual agreements will control who holds that right to trigger the ROFR and to what extent there are required approvals. And Mike, you sort of mentioned this other issue, which is, to what extent, if I receive an offer, maybe from a third party, is that part of the process of triggering the ROFR? And I think if you look at the court cases out there, and there are many, it's not uncommon, in my experience, for there to be some degree of ambiguity in the documents. And in some cases, I wouldn't be shocked if that was by design, but the ambiguity then leads to the potential for different interpretations. And as a result, then you end up with the potential for some conflict between the partners. And that's usually why this ends up in court, if it's going to end up there. But bottom line is always a function of, can the general partner trigger it on their own? Do they need an offer from a third party? Or is merely deciding that they want to sell the property good enough to get the ROFR started? And then it's really just a question of, let's move on to the calculation.
Yeah, good overview. Thanks for sharing that. And you were talking about, looking at what the documents say, some of the confusion, as you know, is that some documents are pretty vague, and they just mention Section 42I7, which is the Internal Revenue Code section that allows for a nonprofit to have a right of first refusal on these terms. So then you have to end up trying to interpret what a 42I7 right of first refusal means, and to what extent there is a federal income tax concept of a ROFR versus the state law concept of a right of first refusal to ROFR. That said, you mentioned you then move on to the calculation. And as you know, once again, the calculation itself, discusses that the right of first refusal price isn't a right of first refusal to meet the price at which it would be offered for sale or which you received an offer. The right of first refusal price is an amount that's no less than the principal amount of debt secured by the building or buildings, plus the federal, state, and local income taxes that would be attributable to the sale. And once again, those words, as you know, sound are pretty straightforward, but it does reference, price equal to the principal amount secured by the property. And that determination usually isn't very challenging. Usually you can identify the principal amount secured by the property. The bigger question in terms of calculations is how do you determine the federal, state, and local taxes attributable to such sale? And there's an iterative aspect to that question. There's how do you treat unsecured debt or accrued interest on the property, on the debt secured by the property, when you're trying to estimate the taxes attributable to such sale? And there's been a variety of arguments that have been asserted in terms of how that calculation is done. And I'm not sure we're not going to resolve that on this podcast, but you're free to share any more thoughts you want, or we can move on to qualified contract process.
I think it's common within the industry when we say debt plus taxes, you say, well, if I'm buying the property, I'll go ahead and assume all the debt. And you're right, the statute does say principal amount secured by the property, but I think as a practical matter, most of the time, since these are nonprofits that are basically taking over the property, they end up assuming all the debt, whether it's secured or unsecured, and whether it's principal or interest. I think that ends up being part of the bargain. Now, obviously, it doesn't have to be that way, but this certainly is, in my experience, the most common approach. And then when it comes to the taxes, certainly it does say attributable to, and by and large, most people being looking for an easy approach will say, well, to what extent does my investor have a negative capital account? Because if the investor has a negative capital account, then the investor will, by the very nature of their exit from the partnership, experience a taxable event. And if the partner doesn't have a negative capital account, then they probably don't have any exit tax. And so that's a non-issue. And if they do have a large negative capital account, then there's probably some exit tax. And you're right that as soon as you start calculating an exit tax amount, an amount that actually has to be paid to that limited partner, then that ends up in this gross up, because you end up having tax on the tax, on the tax, on the tax as part of your calculation. And that's part of the fun of doing the math. I do think as a practical matter, if you have a large negative capital account, chances are that ROFR is not going to get exercised, just because the dollar amount to acquire the property is so great that the general partner will look at that ROFR and say it's an uneconomic ROFR. So as a result, most ROFRs that get exercised often are debt plus no taxes, or just a little bit of tax if there's a small negative capital account. And I think that's the most common way I see these actually go down in terms of a ROFR being exercised and the dollar amount that changes hands. I think in a perfect world, for all the nonprofits out there, they would basically just assume the debt and maybe pay $100 to the limited partner, because they need some consideration in terms of having it being a legally binding contractual trade, but otherwise not give them a whole lot of cash. That's a perfect world. In an imperfect world, there may be a small amount of tax that ends up being paid to the limited partner. But certainly there's room for interpretation here. But I think the good news for most nonprofits is most of the time, not something that's real contentious. And most of the limited partners out there are very willing to exit in a very smooth and amicable fashion where it doesn't end up being a real dramatic exit. It's really, I think, in a minority of cases where a limited partner chooses to make it more exciting and chooses to try to see if maybe there's some value that can be that is there in the property, and decides to attempt to capture some of that value.
And I'd probably say, I'd also just note that, my experience is, fairly similar to yours in that, oftentimes there isn't a large tax due. And that's particularly true with 9% tax credit transactions. But you can look at locally tax credit financed by productivity bonds that have the rights of refusal. There could be a greater amount of taxes due on sale. And generally in those circumstances, the investor needs to get the taxes due. And oftentimes they're willing to negotiate what that amount is. But, oftentimes they need to, as a fiduciary obligation to their partners, if they're a syndicator, they need to get the taxes so that the investors can exit without additional tax on the exit. So I do see a number of transactions where the investor is exiting and getting their taxes paid, and there's not a lot of, and there's a bit of back and forth on the calculation, but it gets reasonably negotiated. And when I've seen it's kind of large amounts, sometimes those can end up being something to be negotiated. But I don't generally see, as I don't think you see, investors who have a large amount due, attributable to the tax, that just walk away from it.
Absolutely. I think there's another wrinkle that we didn't touch on, which hasn't really come to play yet, but is likely to in the coming years, which is the impact of opportunity zone investments. Some investors couple opportunity zones with their LIHTC investments, and one of the salubrious outcomes of opportunity zone investments is there's effectively no exit taxes due to the investor. And I think there's the potential where you might have an exit tax that's otherwise due, and the opportunity zones might wipe out that exit tax. And I think there's room for negotiation around how that ends up getting resolved in a ROFR.
Right. And it does, create a bit of a benefit for a nonprofit to be seeking a opportunity zone investor if they have a private activity bond finance deal. I like often say begin with the end in mind. That would really be an example of beginning with the end in mind. So that's a good discussion. Thank you for that, Nicolo. Let's move on now to the qualified contract process. Now, many of our listeners know, but not every listener knows, that the end of the tax credit recapture period after year 15 doesn't, as a general matter, end the obligation to continue to rent units to low-income families at restricted rents. Following the end of year 15, as I noted, at the end of the recapture period for the investor, but there is a minimum 15-year extended use agreement, which obligates the property to continue to comply with rent and occupancy restrictions. Now, under the qualified contract process, though, the owner of a property can reach out to the tax credit allocating agency and ask the agency to find a buyer of their property at a predetermined qualified contract price, or at least a formula for the qualified contract price is predetermined. And if the agency cannot find a buyer within a year for the property at that predetermined qualified contract price formula, then the rent and occupancy restrictions expire over a 3-year decontrol period for existing residents. Now, the qualified contract price is the statutorily determined formula that most often is well above the market value of the property based on restricted rents. As such, a buyer is seldom found, which generally means qualified contract process most often accelerates the end of the rent and occupancy restrictions. So, Nicolo, I thought it would be a good place to start if you could share with listeners why the qualified contract price formula generally yields an above market value.
Sure. And to really understand why, you probably need to understand the calculation itself. And when you look at the calculation of the qualified contract price, it's equal to what's called an affordable portion and a market rate portion. And the market rate portion is the land in any market rate units. They get valued based on a current appraisal, with the idea being that the land is still subject to the affordability restrictions on an ongoing basis. Then the affordable portion is a more exciting calculation. It's not merely an appraised value. Instead, you look at the outstanding debt on the property that was used to finance those original qualified costs and the equity that was originally contributed to the partnership to finance qualified costs, plus an inflation factor on that equity. And when you think about all that exciting math and the calculation involved in coming up with it, obviously there's a lot of detail and a lot of potential moving parts, but in very broad brush form, when I stop and sort of step back and think about it, often it's really a function of the original costs to buy the property, to build the property, then with sort of this inflation factor on the equity that was used to originally finance the property. And you think about these properties as they're built, often due to the affordability restrictions, often the as-built value is less than the cost, simply due to those restrictions. And the notion is that the equity, the tax credit equity that's raised, is really helping to subsidize that difference, to buy down the cost of building the property. And because that equity is used in the calculation of the qualified contract price, plus an inflation factor, you end up with the price that's calculated under the qualified contract, often, not always, but often being above the current market price that the property could generate if it were placed just on the open market in a sale.
So thanks for that explanation. Now, one thing that I didn't mention in my intro, which I should have, is many in the affordable housing community oppose this strategy because it does accelerate the end of the rent and occupancy restrictions. And as a consequence of that, many allocating agencies don't even allow it. So maybe what's your experience with respect to the number of properties where this is even a real option?
And Mike, you bring up a great point, which is that many allocating agencies don't even allow it. In fact, in order to apply for credits, often you have to contractually waive your rights to the qualified contract process. In addition to that, many properties have multiple restrictions, multiple regulatory agreements or other contractual provisions that require affordability. And the qualified contract, if it's successful, only removes the LIHTC restrictions. So if your property has restrictions for CDBG money or Hope 6 money or HUD restrictions, maybe city or state restrictions, none of those are going to go away when you use a qualified contract. So as a result, when you start thinking about the population of projects out there, a big chunk right off the top aren't eligible simply because the state says, no, if you're going to play in my sandbox, then you're not eligible to use a qualified contract. And then another large chunk due to other subsidies and other sources of financing, other favorable rates and terms, and even development incentives offered by local, county, or state government. Often those restrictions aren't going to go away. So as a result, if I had to guess, nationwide, I would guess it's a pretty small fraction of properties that are even theoretically eligible would benefit from using the qualified contract process. And I would guess it's 20 to maybe 30% of deals nationwide. And it might even be less than that. I might be guessing high.
No, I agree. It's hard to know what that percentage is, but it's definitely very low. And states like California never allowed it, and many other states and allocated over time have restricted it. And I would say that it does tend to occur more often with privately bond finance properties than it does with respect to 9% allocated credit properties. Look at some of the data on properties where the rent restrictions have went away, it's definitely heavily dominated by private activity bonds in those properties that where the bonds themselves are being allocated in states with excess capacity. Not always. I can think of a few areas of the country where they use all their private activity bonds, and they also have a dominance of properties where the qualified contracts have been submitted. Anything else you want to say on that, or should we move on to resyndication?
It's probably helpful just to observe that the way the process works, once a property reaches the end of year 14, the owner can submit an application to the state. The state, when they receive the application, they have 12 months to then go out and find a buyer at that price. And it has to be a bona fide offer, so it couldn't have obscure and uneconomic conditions attached to it. And if the state is unable to find a bona fide offer at that price, then as you mentioned, Mike, the property can then convert to market over a period of 3 years. And I think as a fundamental matter, the only qualified contracts that get submitted are in situations where the calculated price is way above market, such that no one in their right mind would ever actually pay that price. And as a result, it's common that qualified contracts are successful just due to that self-selection aspect of the process. But fundamentally, the other element is that you have a lot of nonprofit and mission-driven organizations in our world. And obviously, they're not going to be interested in pursuing, generally speaking, not going to be interested in pursuing the qualified contract process simply because it's anathema to their mission and approach as an organization. So often this is going to be more for-profit organizations. And even then, it's often more a function of properties that are really struggling, where maybe converting them to market might be one of the few avenues for really preserving the property without having it slip into foreclosure.
And that is a point there. I mean, it's rare, but it's not unheard of in the affordable housing world. The ongoing compliance costs of dealing with the rent and income restrictions aren't nothing for that next 15 years. I'd also note for listeners, this isn't, an exhaustive podcast on qualified contracts, and there's a lot more that we could be discussing here. But I would remind listeners that many states do give negative points to developers who use this strategy. So even if a developer has a particular right to do that, they will not exercise it because they know there'll be negative points for future rounds if they were to avail themselves of the right. And that's generally in states that have since required it to be waived. They have existing properties that still have that right. And I would also note that there's been federal legislation introduced to either remove this option on a prospective basis and or remove it even on prior properties on a retroactive basis or retrospective basis. So there's definitely a lot here, and I'd encourage listeners to reach out to Nicolo if they have additional questions in this area.
We do work a lot with clients to do the calculation. So if you need help doing the math just to see what the calculation looks like, reach out. We're happy to assist.
So we've talked about the right of first refusal, often held by non-qualified nonprofits. We've talked about the qualified contract process. Now let's turn to resyndication. For many properties, resyndication is a desired choice because at year 15, a property can have notable capital needs, given some typical wear and tear on a resident property. And in many situations, the property doesn't have sufficient reserves at the end of year 15 to fund some much needed repairs or renovations. And I mentioned desired choice. Might be desired, but not always a possible choice. Choosing to resyndicate a property isn't simple. So I thought, Nicolo, it'd be good if you shared with listeners maybe what we mean by resyndication, because we're talking about resyndication with tax credits, and then maybe some of the challenges faced and ways to overcome them.
Sure. And when we talk about resyndication, it's shorthand for taking an existing deal that's reached the end of the initial compliance period, that initial 15-year compliance period, and using that existing property to do a new AC rehab deal. And most of the time that means it's going to be a 4% bond deal rather than a 9% AC rehab deal. And it is, I would estimate, a fairly popular approach to dealing with year 15, where I would guess that well over half of properties, sometime after they reach year 15, and it might not be right at year 15, it might be in the succeeding years, but they decide that in order to address some of the lingering deferred maintenance, that an AC rehab resyndication transaction is a great approach to take to address a lot of that deferred maintenance and reposition the property for the next 15, 20, 30 years of its life cycle.
And I would add to that it is something that is a function in many parts of the country as to the availability of private equity bonds in a given state. And if you go back, 3, 4, 5 years, a lot of states started having a lot more of the private equity bond cap being used for new construction. As a consequence, the ability to use the strategy really wasn't available in those states. And it's been interesting to watch over the last 30 plus years how private equity bonds and ability to use them for AC rehabs and or new construction sort of varies over time. What are some of the challenges beyond getting private equity bond cap? Maybe discuss some other issues that owners of property should be thinking about. Beyond, obviously, it's a gating question. If I can't get private equity bond cap and or can't get allocated credit, then resyndication isn't much of an option.
But let's assume that away for the moment. And I think the other big issues tend to be technical issues. There's a 10-year hold requirement. The whole idea is in order to qualify for the acquisition credits, the existing building must meet the 10-year hold rule. And because if you don't qualify for the acquisition credits, your deal probably doesn't pencil. And I think a large part of that is simply due to the fact that often that ends up being 50 to 60 to 70% of your total credits that are generated for the property, simply because the acquisition price is so high relative to the amount of rehab that's being done. There are also what we call anti-churning rules. And I suppose churn means different things to different people. We're not churning butter here, but there are limitations that effectively limit the ability of the same investor and the same developer to roll over into the new property and limit the percentage of ownership that they have in that new partnership when you roll from the old partnership into the new partnership that resyndicates the property. And first and foremost, it means you probably need a new tax credit investor. You're probably not going to be able to use the same one that you used on the original deal. Perhaps more thrillingly for the developers out there, it means that your share of partnership items is going to be limited to less than 50% in the new partnership. And that includes your share of residual proceeds. So for a lot of developers out there, you're used to negotiating very aggressively or on your cash flow waterfall to maximize your share of the residual proceeds. In some cases, maybe even negotiating for as much as 90% of that residual value. And yet, due to these anti-churning rules, you're limited to 50%, or I think just a hair under 50% of that residual value. And so certainly that is not an insignificant consideration for a lot of developers. But setting those issues aside, then you get into a lot of economic issues around, well, what's this property worth, the existing property? And how much of that existing value really needs to be rolled into the new deal in order to make the new deal pencil? While the tax credit equity generated by the acquisition and rehabilitation tax credits will finance a decent chunk of the tax credit of the capital stack, the odds are good that you're going to have a gap. And that gap will probably need to be filled. You could fill it with soft financing, other sources, but it's very common in my experience for there to be a seller carryback note and for that to serve as a form of soft financing and gap filling financing. The seller carryback note does need to have interest at least AFR. And in a lot of ways, economically speaking, this is a way for the existing ownership group to roll over their equity into the new deal and carry that back in the form of a seller carryback note. And those are a lot of the issues that many of my clients have to work through as they work through the economics associated with doing an AC rehab deal. Obviously, the biggest issue is always, well, A, can I get bonds or credits? And then B, does the math work? Can I make the math work where the amount of money I need to spend to acquire and rehabilitate the property matches up with the amount of sources available, including that seller carryback note, in order to fundamentally make the property work? And the good news is, assuming you've got a willingness to carry back a decent seller carryback note, usually deals can be made to work.
I think that's a great point. A lot of great points there. The one about the seller carryback note, I think pretty notable in the sense that, as a nonprofit or for-profit affordable housing developer, you could sort of face that choice. Do I do a resyndication? And as you pointed out, leave equity in the transaction through the seller carryback note, or would I rather, put the property out into the market, have a new owner come in, get that equity, and then reinvest that equity in additional affordable units. And those units have rent restrictions on them for, generally speaking, for at least 15 years, maybe longer. And it is a, sort of a strategic strategy choice that entities need to make as a general matter. I also think this is a good topic to do sort of at the end here. I probably should have referenced in the intro that this question about resyndication, as you also mentioned in your response to the question, isn't necessarily something that just, happens in year 16 or 17 or doesn't at all. Oftentimes this is step 2, 3, or 4 after the investor exits, which means when you're structuring the investor exiting at the end of year 15, you need to structure that exit in a manner that preserves this 10-year hold requirement. So that is, you don't want to, and that's something that is quite common in the tax credit space here, is at the end of Y15, whatever the exit is, preserving the ability to do a resyndication into the future, such that maybe you end up bringing the investor gets out and then you continue to operate the property because you don't have large capital needs at year 15, but year 20, year 2025, now you have larger capital needs, and you've preserved the ability to do a resyndication and get tax credits on the existing acquisition.
And it's important to note there are exceptions to the 10-year hold rule.
Yes, there are.
And those exceptions are certainly available, and many groups do qualify for them, but you wouldn't want to have to force yourself by violating the 10-year hold rule and then have to find a way to meet one of those exceptions if you weren't otherwise meeting it.
Or at least if you're, as the investor's exiting, identify what those are, make sure you're forced to. Yeah. I appreciate you pointing out those exceptions. And I would just note for listeners, in the course of this podcast, there's been lots of things that we've said that have exceptions and general rule and all the rest. So, this isn't an exhaustive podcast. So I'm obviously stating the obvious, but sometimes it's useful to state the obvious.
Otherwise, we'd be here all day.
And that would be fun. So, I think we've made clear in discussing the 3 approaches or strategies that none of them are simple, and they all have lots of complexity to them, and every situation is truly unique. It's kind of like, I recently learned, it was pointed out to me, and I can't remember where, and I find it so obvious, but also so surprising. It kind of applies in the situation here with a given property, in that when you have a deck of cards, there's 52 cards, obviously, and when you shuffle them and get them mixed up, uh, that organization of the cards has never occurred before in that order. Because when you think about the cards, it's basically 52 factorial in terms of the number of possibilities of a randomly shuffled set of cards. So 52 times 51 to 50 blah. So it's such an immense number that the cards have likely never, almost assuredly have never been in that place before, in that order. And when I think about a tax credit transaction, I think every transaction is unique in a variety of ways. The facts have never lined up that way before. And so there is nothing that's cookie cutter. There are things to be more or less cookie cutter, but every situation is truly unique, which is a bit of a observation that you might take as one of self-interest. Importance of having experienced counsel from tax and legal professionals can be so vital when you're dealing with these year 15 issues. But Nicolo, before we wrap up, is there anything else you think our viewers or listeners should know? I know there is. Maybe you can share a few things. Additional matters.
I think my advice would certainly be to educate yourself. There are lots of resources within the industry. We have the Year 15 handbook. I just did a Year 15 webinar a few weeks ago as well. Obviously, we've got this podcast. We have our Journal of Tax Credits. You have our conferences. There's a wealth of resources you can avail yourself of and spend the time to make sure you understand all the issues. Certainly, Mike, as you mentioned, the importance of qualified counsel and experienced counsel is critical. This is no time to be working with someone who's fresh in the industry and doesn't know what they're doing. And the good news is there's lots of attorneys, and certainly we at Novogradac are here, an incredible wealth of resources within our firm, and we're available and happy to assist. If you just need a little bit of help, we're happy to assist with just a little bit. If you're a babe in the woods and you need a tremendous amount of help, well, we're here to help you as well. And I think my last point of observation is that while this is certainly challenging and there's a lot of details to be managed, it's doable. It's definitely doable, and others have done it before and done it successfully and done it well. And by golly, if they can do it, you can do it too. And so you shouldn't walk away from this discussion feeling like this is an impossible task and you'll never be able to manage it, but rather that there's a lot to be managed, and with the right help and with a little bit of practice and experience, you can make it happen for your project as well.
Great. Thank you for that, Nicolo. I appreciate you being on the podcast today. And to our listeners, as I noted earlier, I will share Nicolo's contact information in today's show notes, so you can reach out to him directly. I'll also share links to the 2 previous podcasts about Year 15. They're definitely worth listening to, even if merely as a refresher. I also would like to encourage you to share this podcast and those prior 2 podcasts with other members of your underwriting, acquisition, asset management, finance, and other aspects of your development team. And as I also mentioned earlier, at next week's podcast, we'll continue this in-depth discussion of certain Year 15 matters. My partner, Kevin Wilson, and I will review some GAAP, or generally accepted accounting principles, considerations that investors face at Year 15. Kevin's the perfect guest because he updated the chapter in the Year 15 handbook on that topic. These are issues or matters that are front of mind to investors. And if they're front of mind to investors, it means that as a developer or general partner, you want to understand them as well. You can better negotiate the exit with your investor partners. And then before we do get to the off-mic section, I do want to remind our listeners to subscribe to our podcast, whatever platform or platforms you prefer. And also encourage you to share the podcast with your colleagues who may be interested. And then also, we always appreciate leaving a review of the podcasting platform of choice. So, Nicolo, now let's turn to our off mic section. And this has turned into a fun segment where we get to acknowledge our industry colleague. So, Nicolo, who would be your industry shout out of the week?
Well, there's so many to choose from. Certainly, the beauty of our world is there's a lot of colleagues that we work with. So picking one can be a little exciting, and hopefully no one feels like they're being overlooked or somehow disrespected if they didn't get picked. But if I had to pick one that comes to mind, my good friend Scott Pollock at Sidley Austin. Scott and I have worked pretty extensively together over the years, and we have a great relationship, and we have several mutual clients that we work with. And we're fortunate enough that whenever one of us finds ourselves in a sticky situation where we're working through exciting technical issues or have questions and want to bounce ideas off the other, where we have the sort of relationship where we can pick up the phone and make a phone call and pick the other's brain on what we're cooking with these days. So just wanted to shout out to Scott and thank him for his friendship and all the great times we've enjoyed together in the LIHTC world as we serve our mutual clients.
Great. Thank you for that shout out, Nicolo. My shout out to Scott as well. And Sidley in Austin has been around the LIHTC world for many, many years. And he had big shoes to fill with prior attorneys at the firm. And I know that he's filling them well. So thank you, Nicolo. And to our listeners, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.